Welcome to the deep dive. We know you want to get smart about important stuff fast without getting buried in information. So today we're tackling personal finance. It's complicated out there, right? We're going to unpack it all. Wealth creation, common mistakes, investing, saving, basically cutting through the noise to get to what really works for your money. We'll hit insurance, emergency funds, scams, real estate versus stocks, tax, mutual funds, even the psychology behind it all, the aim, actionable insights you can actually use.
That's the plan. We're trying to, connect the dots, give you the big picture, and hopefully show you where you fit in and what steps make sense for you. Left jargon, more why.
Okay, great. Let's dive right in. Where do people trip up most often? I feel like one huge thing is wanting to get rich, like yesterday.
Ah, yes. The lure of quick wealth is powerful. You see these schemes everywhere, don't you? Some crypto things, these weird color trading apps popping up. They promise the moon overnight.
And people fall for it.
They do, because fundamentally we're wired for instant gratification.
Yeah.
But here's the thing. Genuine wealth creation. It's slow. It's steady. We're talking 20, maybe 30 years. It's a long game.
Not a lottery ticket.
Exactly. These schemes exploit psychology,
Sure.
FOMO, fear of missing out. Everyone else seems to be getting rich, so you jump in. Herd mentality. But there's no shortcut, really. Understanding that is the first step to avoiding disaster.
And this impatience, does it also feed into spending habits, especially maybe younger folks? I see a lot of pressure.
Definitely. There's huge pressure, often from social media, right?
Yeah.
Showing off a certain lifestyle. And sometimes concepts like FIRE, financial independence, retire early, get twisted.
How so? Twisted how?
Well, the core idea of FIRE is sound financial security, having options.
Yeah.
But it can be misinterpreted as this desperate race to quit your job now at any cost. So people might take huge risks or skip crucial steps, like getting into debt straight after payday, taking out loans for things they don't truly need, maybe a fancy gadget, a trip before they've even thought about saving anything. It's a cycle that's hard to break.
Okay, so if someone's listening and wants to avoid those traps, build a solid foundation.
Yeah.
What are the absolute rock bottom first things they need to do before anything else?
Protection. Number one, absolutely non-negotiable. Protect yourself and your dependents. That means getting adequate insurance. Medical insurance, obviously, and life insurance.
Life insurance, even if you're young.
Especially term life insurance if you have people relying on your income, a spouse, kids, even parents sometimes. Think about it. One major health crisis can completely drain your savings. Gone.
Right.
And if the main earner passes away unexpectedly, term insurance provides that safety net so the family isn't suddenly facing financial ruin on top of everything else.
Yeah.
Protect the downside first.
Makes sense. Start, but yeah, makes total sense. Protect first. Step 2, right after insurance.
The emergency fund. This is your cushion against life's surprises. You need enough cash set aside, easily accessible to cover, say, at least 6 months of essential living expenses.
6 months? That sounds like a lot.
It can seem daunting, yeah. But life throws curveballs, right? You lose your job, your car breaks down needing a major repair, a pandemic hits. Having that fund means you don't have to dip into investments, or worse, go into high-interest debt just to cover essentials. It keeps your main plan on track.
Okay, so insurance, then emergency fund. What about things like pension plans? Should people start those right away?
Pension plans are crucial for the long term, absolutely. But they come after you've covered your immediate risks, health, life, and built that emergency buffer. Your primary focus early on is usually generating income and managing current financial stability. You build the foundation before you worry about the penthouse,
Got it. Foundation first. Okay, let's shift gears a bit. Saving habits. There's some interesting stuff suggesting younger people in India are actually quite focused on saving and investing early. That kind of goes against the stereotype, doesn't it?
It does. Yeah. And it's a fascinating trend if the data holds up. We are seeing reports suggesting that people in their 20s even are not just saving, but actively starting to invest. There seems to be a greater awareness, perhaps.
Why do you think that is? More information available now?
That's likely part of it, yeah. The internet financial literacy resources are more accessible than ever before. Maybe seeing previous generations struggle without enough retirement savings has had an impact too. But,
But
well, you always have to take survey data with a grain of salt, right? People might present a slightly rosier picture of their financial habits than reality. Social desirability bias, they call it.
True. Good point. So how does this compare to, say, older generations, people who started working before, like the big economic changes in the early 90s?
Right. For those who entered the workforce pre-1991, the landscape was totally different. Investment options were really limited, mostly fixed deposits, maybe some LIC policies. That was kind of it.
So safe, but maybe not much growth.
Exactly. Very conservative. They saved, definitely, but the growth potential was much lower. So unfortunately, some might find their retirement savings aren't stretching as far as they need them to now.
And for those who started working after 91, when things opened up.
That's a whole different ballgame. Post-liberalization, you had the rise of the stock market, mutual funds became accessible, a whole new world of wealth creation opportunities opened up. If you started investing in equities or mutual funds back then and stayed invested, well, you've likely seen significant growth.
Which brings up a good point. What is an investment, actually? Seems like people get confused. Is buying an expensive watch an investment?
That's a crucial distinction. An investment is something you buy with the expectation that it will generate income or appreciate in value over time. Stocks, bonds, mutual funds, maybe income-generating real estate.
So not the fancy handbag?
Probably not. I mean, some luxury goods might hold some resale value, but you're generally not expecting them to grow significantly or pay you dividends. It's consumption, mostly. An investment should, ideally, work for you.
Okay, clear. Let's pivot to something less positive, but really important. Scams. Financial scams. They seem to be everywhere and getting scarily clever.
They really are. The landscape is constantly shifting. It's not just the old email phishing anymore, though that's still around. Now you've got highly sophisticated stuff.
Like what? What should people be watching out for?
These digital arrest scams are becoming more common. Scammers impersonate police or government officials, maybe CBI, ED.
Wow, how does that even work?
They call you, create immense panic. They'll say there's a warrant out for you, maybe linked to some money laundering case, often involving a package with illegal items supposedly in your name. They sound very official, use jargon.
And they pressure you.
Immense pressure. They'll tell you not to hang up, not to talk to anyone, often demand you get on a video call like Skype so they can monitor you. Then they'll push you to transfer money immediately to resolve the fake issue or verify your accounts. They might even use AI to fake videos or voices.
That sounds terrifying. It's hard to believe people fall for it, but I guess in the moment.
Exactly. Panic overrides rational thought. And it's not about being unintelligent. We've seen cases involving highly educated, smart people getting completely taken in. These scammers are masters of psychological manipulation.
And if someone does get scammed, they often don't report it, right? Why is that?
There's a huge amount of shame involved. People feel embarrassed, foolish. They don't want to admit it happened, even to families sometimes, let alone the police, which of course just allows the scammers to continue preying on others.
Such a difficult situation. Okay, changing track slightly. Let's talk about how we actually pay for things. Cash versus digital. There's a big push for digital, UKIs everywhere, but sometimes it feels like cash is viewed suspiciously now.
It's an interesting tension, isn't it? Cash is legal tender, but yes, there's definitely a move away from it, partly driven by government initiatives. The idea is that digital transactions leave a trail, which can help curb black money, improve tax collection, make the economy more transparent.
Which sounds good on the surface, but what's the downside?
Well, the main concerns are around privacy and surveillance. If every single transaction is tracked, where does that lead? Does it give governments or corporations too much insight into our lives? That's one side.
And the other.
The other potential issue is behavioral. Some argue that the ease of digital payments just tapping your phone makes it easier to overspend. You don't feel the pain of handing over physical cash. It's almost too frictionless.
Yeah, I can see that. It's easy to just tap and go. So any practical tips for managing spending in this digital age?
One classic piece of advice still holds true.
Okay.
Pay yourself first. Decide how much you want to save or invest at the beginning of the month, as soon as you get paid. Transfer that money out to a separate savings or investment account. Then you manage your spending with what's left. It imposes some discipline.
Makes sense. Create intentional friction. Okay, let's tackle a big one. Real estate versus financial assets. The age-old debate for investors in India.
Right. Real estate is huge, obviously. It drives a lot of economic activity, construction, materials, jobs, everything. But as a personal investment, it has its challenges.
Like illiquidity.
That's a major one, yes. It's not easy to sell property quickly if you suddenly need cash, compared to stocks or mutual funds, which you can usually sell within days. Also, the returns aren't always guaranteed to beat financial assets over the long term, especially after accounting for costs like maintenance, property taxes, and registration fees.
What about gold? That's another traditional favorite.
Gold has huge cultural significance, and it's seen as a safe haven. But from a pure economic growth perspective, Some argue it's a bit of a liquidity drain. It sits there, looking shiny, but it doesn't directly fund businesses or contribute to GDP growth in the way that, say, investing in an index fund does. Equity investments mean you're participating in the country's overall economic journey.
And real estate in India specifically, are there unique hurdles?
Oh, definitely. The process can be complex. Documentation can be a nightmare. There's often a significant cash component involved in transactions, which adds risk. Builder reliability is a huge factor. Delays, quality issues.
Market fluctuations too, right?
Yeah.
Finding reliable tenants if you rent it out.
Absolutely. Property values can stagnate or even fall. Renting it out involves finding good tenants, dealing with repairs, potential vacancies. And we haven't even mentioned risks like unclear land titles or even natural disasters, depending on the location. It's not passive income usually.
It sounds like a lot of work, but people still feel very strongly about owning a home, don't they? It's emotional.
Hugely emotional. The dream of owning your own home, that sense of security and stability, it's powerful. And that's perfectly valid, but you need to weigh that emotional pull against the financial realities. Is it truly affordable? Does it fit with your career path? What if you need to move for a job? How much time and money will upkeep realistically take? Sometimes renting makes more financial sense, even if it doesn't feel the same emotionally.
It's a tough balance. Okay, shifting to everyone's favorite topic, taxes. There seems to be a feeling that the burden isn't shared very evenly.
That's a common sentiment, yes.
Mm-hmm.
There's a perception, and some data supports it, that a relatively small percentage of the population, mainly the salaried middle class, bears the brunt of direct income tax.
While others, maybe with large agricultural incomes, for example, are largely outside that net.
Correct. Agricultural income, for historical reasons, is largely tax-exempt, and that's a point of debate. Plus, there's the informal economy. So, yeah, there's a feeling that the base of direct taxpayers is too narrow.
And GST. It was meant to simplify things. Has it?
The goods and services tax. The intention was definitely simplification, replacing a whole mess of different state and central taxes. But the implementation, well, it's been complex. Multiple slabs, frequent changes, compliance burdens for small businesses. It hasn't quite delivered the one nation, one tax simplicity that was hoped for, at least not yet.
So you have direct tax, like income tax, and indirect, like GST on things we buy.
Exactly. And the complexity of GST still means businesses face challenges, and that can indirectly affect consumers too.
So what's needed to make the system feel fairer and maybe work better?
Broadening the tax base is key, bringing more eligible people and businesses into the formal tax net. That requires government initiatives, better data analysis, plugging loopholes, but also, crucially, the political will to make potentially unpopular changes. It's about ensuring sustainable funding for public services that benefit everyone.
Right. Okay, before we jump into specific investments like mutual funds, you mentioned something earlier that feels foundational, goals. Defining your financial goals before you invest. Why is that so critical?
Because money is just a tool. It's a means to an end, not the end itself. If you don't know why you're investing what you're trying to achieve, how can you possibly choose the right strategy?
So the goal dictates the path.
Precisely. Are you saving for a down payment on a house in 5 years? That needs a very different approach. Probably lower risk than investing for retirement that's 30 years away, where you can afford to take more risk for potentially higher growth. Your child's education fund will have a specific time horizon. A short-term goal needs safer instruments. A long-term goal might involve more equities. Without the goal, you're just investing blind.
Okay, that makes sense. Define the destination first. Now let's talk mutual funds. It can seem like a confusing jungle out there. What are the basics people need to grasp?
At a high level, mutual funds pool money from many investors to invest in a diversified portfolio of assets. You can broadly categorize them by what they invest in. Equity funds invest mostly in stocks, higher potential returns, higher risk.
Okay.
Debt funds invest in fixed income, things like government bonds or corporate bonds, generally lower risk, aiming for stability and regular income. And then you have hybrid funds, which mix both equity and debt in various proportions, trying to balance growth and safety.
So for someone just starting out, maybe feeling a bit overwhelmed, where's a good place to begin looking?
Often, a good starting point is an index fund. These are passively managed funds that simply aim to replicate the performance of a major market index, like the Nifty 50 or the Sensex.
Why start there?
Several reasons. They offer instant diversification across many top companies. Their costs, the expense ratios, are typically very low because there isn't an active fund manager making constant buy-sell decisions. And they give you a good feel for how the overall market behaves without needing to pick individual stocks or complex funds right away.
We hear terms like large cap, mid cap, small cap a lot with equity funds. What do those mean?
Right. Those refer to the size of the companies the fund invests in, based on market capitalization, basically, the total value of the company's shares. Large caps are the big, established blue-chip companies. Think stability, usually lower volatility.
Okay.
Mid caps are medium-sized companies. They often have more growth potential than large caps, but also come with a bit more risk. Small caps are the smallest listed companies. They can offer the highest growth potential, but they're also the most volatile and riskiest category.
So it sounds like just chasing the fund that performed best last year isn't the smartest strategy, or listening to random tips.
Definitely not. Past performance is no guarantee of future results, as they always say. And investing based on tips from friends or, random websites is basically gambling. You need to understand what you're investing in and why it fits your goals and risk tolerance.
So do your homework or get proper advice.
Exactly. Either take the time to learn, there are lots of resources now, or consult a registered investment advisor, RIA, who has a fiduciary duty to act in your best interest. You can also work with a mutual fund distributor, but understand they earn commissions, so their advice might be influenced by that. For most retail investors, honestly, sticking with mutual funds is generally better than trying to pick individual stocks themselves. It's hard to beat professional management and diversification.
If someone's building a long-term equity portfolio with mutual funds, how should they think about mixing those cap sizes? Like, is there a rule of thumb for allocation?
There are different approaches, but a common starting point for a long-term growth-oriented portfolio might be something like, say, 50% in large cap funds for stability, maybe 25% in mid caps for that growth kicker, and 25% in small caps for potentially higher, though riskier, returns.
And that allocation isn't set in stone forever?
No, absolutely not. You need to review it periodically, maybe once a year, and rebalance. If small caps have shot up, they might become too large a portion of your portfolio, increasing your risk. Rebalancing brings your allocation back in line with your target. And it's good to know the mutual fund industry in India is quite well regulated by SEBI, which provides a decent layer of protection for retail investors like us.
Okay, that's helpful. Now, let's venture into controversial territory. Cryptocurrency. Lots of hype, lots of debate. What's the balanced view here?
It's definitely polarizing. On one side, you have advocates who see crypto, like Bitcoin, as this revolutionary decentralized alternative to the traditional financial system. Freedom from government control, potential for huge returns. That's the narrative.
And the other side?
The other side points to the extreme volatility prices swinging wildly. The lack of clear regulation in those places. The history of scams and hacks is undeniable. And, fundamentally, what is the underlying value? For many cryptos, unlike a stock which represents ownership in a company, it's not always clear what you're actually buying.
The scam angle seems particularly worrying.
It is. The crypto space has unfortunately attracted a lot of bad actors. Pump and dump schemes, fraudulent initial coin offerings, ICOs, exchanges collapsing. Investors have lost billions, and the anonymity it offers can sometimes facilitate illicit activities.
What about the argument that it's like digital gold? Because of scarcity. Bitcoin has a limited supply, right?
That scarcity argument is made, yes. Bitcoin has a coded limit. But then again, thousands of other cryptocurrencies have sprung up. So is the overall digital asset space truly scarce. And unlike gold, which has thousands of years of history as a store of value and use in jewelry and industry, Bitcoin's track record is barely over a decade old. Plus, regulation is still a big question mark. What happens if governments crack down harder? What about security? If you lose your private keys, your crypto is gone forever, usually with no recourse.
How are governments like India's treating it now?
Cautiously and often skeptically. India, for instance, taxes crypto profits at a very high rate, similar to lottery winnings. That signals they view it more as speculation or gambling than a serious investment asset class. Some experts think crypto might eventually become a recognized asset class, but perhaps only if major, stable democracies start holding something like Bitcoin as a reserve asset, similar to how they hold gold. But we're not there yet.
So handle with extreme care, basically.
Or perhaps avoid altogether if you're not comfortable with very high risk and potential total loss. It's certainly not a place for your emergency fund or money you can't afford to lose.
Okay. Let's shift to something maybe less technical, but just as important. The psychology of money, how we feel about it, talk about it, or don't talk about it. Why are people often so secretive about money, especially maybe within families?
That's a really deep-rooted thing, I think. There are cultural factors, certainly. Historical norms where maybe the head of the household controlled all the finances. Sometimes there are hidden assets, money kept aside that one partner doesn't know about.
Power dynamics.
Definitely. Money is often linked to power and control within families. Talking openly about it might shift those dynamics. There can also be shame associated with debt, or even embarrassment about not earning enough, or sometimes even guilt about having too much. It's complex.
And the secrecy. What problems can it cause down the line?
Oh, huge problems, especially during big life events. Divorce becomes incredibly messy if assets are hidden or finances weren't transparent. Inheritance can turn into a nightmare if there's no clarity about who owns what, or if there are secret accounts or debts nobody knew about. Managing joint family assets becomes almost impossible without open communication.
So transparency within the family is pretty crucial then.
Ideally, yes. Open, honest conversations about money budgets, goals, debts, assets build trust and make planning much easier. It helps ensure everyone's on the same page. Things like creating a clear financial trail, having proper documentation for assets, and definitely having a will. These are vital steps to prevent chaos and conflict later on.
Speaking of documentation and process, KYC, know your customer. It's necessary, but boy, can it be frustrating. Why does it feel so repetitive sometimes?
KYC. Yeah, it's a pain point for many. It's absolutely essential for banks and financial institutions to verify identity and prevent money laundering and terrorism financing. The intention is good.
But the execution.
The execution can feel incredibly inefficient. You submit the same documents, a AHAR, PAN card, photos over and over again to different entities, bank accounts, mutual funds, insurance, demat accounts. It feels like there should be a more centralized, streamlined way, right? Like a one-time verification that all regulated entities can securely access with your permission. We're not quite there yet, which leads to a lot of understandable frustration.
Definitely. So at the end of the day, it all comes back to our individual relationship with money. How should people think about that? How do you cultivate a healthy perspective?
It's about finding balance, isn't it? Money is important. It provides security, options, freedom. But it shouldn't be the only thing that matters. Avoiding excessive attachment where money becomes your sole measure of success or happiness is key.
But also avoiding complete detachment, like pretending it doesn't matter.
Exactly. You can't just ignore it.
Yeah.
Financial responsibility is important. So it's about understanding your own beliefs about money. Where did they come from? What are your emotional triggers around spending or saving? Aiming for a perspective where money is a useful tool that serves your life goals and values rather than dictates them. It's about conscious control.
Okay, so bringing this all together, as we wrap up this deep dive, how should we think about the ultimate purpose of money? What does the good life really mean in this context?
That's the big question, isn't it? Initially, money helps solve basic problems: food, shelter, security. It creates opportunities, education, travel, experiences. But for many people, as they achieve a certain level of financial comfort, the focus starts to shift
Shifts how?
from purely accumulating more towards contribution, giving back, using resources not just for personal gain, but to make a positive impact on society, on causes they care about, on the lives of others. The purpose evolves.
So it becomes less about me and more about we.
Often, yes. It encourages you to think, if I had enough, what would I do with my time, my energy, my resources? What truly matters beyond just having more money in the bank? How can I live a life of purpose, aligned with my values?
This has been incredibly insightful. We've covered so much ground, from the first steps of insurance and emergency funds to the complexities of investing, taxes, and even our own psychology around money. It really underscores that financial literacy isn't a destination, it's a continuous journey, right?
Absolutely. The landscape keeps changing, and we need to keep learning and adapting. Hopefully, listeners can take some concrete actions from our discussion today. Maybe it's checking your insurance coverage, starting that emergency fund, or beginning to explore index funds if you haven't already. Remember your goals. Understand your risk tolerance.
And maybe take a moment to reflect on that bigger question we just touched on. How should your values, your long-term aspirations, shape your financial choices? Because ultimately, financial literacy isn't just about getting rich. It's about empowering yourself to build a life that's secure, meaningful, and truly fulfilling for you.
Well said. It's about using money as a tool to live the life you value.